All right. So, hi everyone. Welcome back to the channel. Before we jump into today's masterclass, a very important and standard disclaimer from us mods. Nothing discussed in this episode across the anonymized podcast series or posted within our Reddit communities, including our FIRE_IND, our FIRE India, and our India Finance, is to be construed as financial, tax, or investment advice. Every individual's risk profile, financial obligation, and life goals are completely unique. Please ensure you conduct your own thorough due diligence, run your numbers carefully, and consult a qualified SEBI registered investment advisor or certified financial planner before making any financial decisions. Now, with that essential foundation set, today marks the official premiere of a brand new anonymized podcast series. The premise is simple. Our community members submitted their raw, unfiltered financial situations, net worth breakdowns, career pivots, and retirement fears completely anonymously on Reddit. And we have brought in one of the sharpest, most grounded minds in Indian finance to answer them live. Please welcome Mr. Sanjay Kathuria. Sanjay sir, a big fan of yours.
Thank you so much. Thank you so much, Snaky, for inviting me. And thank you so much for the entire community to pose such wonderful questions. I think they were very, very, very good questions.
All right. So, just to give in a brief about Sanjay sir, Sanjay is a CFA, MBA in finance, former corporate strategy leader who had achieved FIRE at the ripe age of 39 and is the creator behind a massive 4.5 million plus personal finance community. Sanjay, a very warm welcome once again to the show.
Thank you.
Hoping
Thank you
to
so
have the
much.
most of it.
Thank you.
All right. So, Sanjay, let me just come over here and tell you first about what exactly happens in this podcast series. What
Mhm.
we did is we did the AMA post, which you had graciously sent your pic to us along with the name of the community. So, thank you so much for that. And I would like to tell you that the reception to that post was humongous. Our community had around 80,000 people, and out of that, almost 50,000 people viewed that post. So, more
Wow.
than 70% people approximately were able to view it. There have been 50 plus responses, and we have tried to cluster them together in 19 specific themes, which we would like to discuss in this particular podcast. It'll be nothing short of a masterclass from your end, and we'll try to touch upon people from every stage of life, that is, from the young 20s starting out to mid career portfolio restructuring people, people who are returning NRIs, people who face sudden layoffs, and the psychology of life after corporate life as well. So we can't wait to discuss these questions with you. And I'd request all the audience to grab their chai, a notebook, and let's get going.
I have grabbed my chai.
Great. And I have my coffee with me as well. So let's dive straight into this. The first question, and I think this is the one which creates a lot of controversy on Reddit every single week. It is about fire multiple. Now, as we all know that there is this mythical fire multiple, we had questions coming from the Reddit users anywhere_life22, Saransh 000, and general subject 3323. They were basically challenging the entire premise of fire multiple itself. Saransh literally asked, why do we need 30x? If you retire at 55, do you really think you will last till 85? And if 10 crores is the benchmark on the other hand, then 99% of India will never retire. Sanjay, break this down for us. What is the real math behind 25x, 30x, 50x debate? And how on earth should someone model their education and medical inflation to get to this corpus?
Very, very beautiful question. And I think Saransh has challenged it very well. Let me break it down in a very detailed and a simplistic manner. See, first of all, we have to understand that, when you talk about expenses, expenses are like a balloon. Okay. If you look at a balloon, what happens? Initially, there is no air in the balloon. Then you fill the air in the balloon, it becomes big. And when you just open that again, and it becomes small. So expenses also are like that. So let us break down our life expenses into 4 to 5 parts. The first layer, and assume it like a pyramid. Okay. Let's say the first layer of the expenses is your household basic expenses, which will always stay with you till the time you die. Okay. So these could be your groceries, your
Correct.
rent, your, let's say if you don't have a house, then rent, groceries, basic stuff which you require on a daily basis, travel, commute, so on and so forth, right? So this is your absolute basic of life. You want to go out for dinner, you want to travel, all these very, very basic stuff which will always stick around with you till the end of your life. So that's the layer one of your expenses.
Correct.
The layer two of your expenses, when you're not financially independent yet, the layer two of your expenses is your EMIs, which is basically could be your home loan, could be your car loan, could be any other loan, marriage loan, honeymoon loan, travel loan. Today, for every life event, there is a loan, right? So you could have those kind of EMIs, which is layer 2 for you. Now, when you graduate in life, you become married and you have kids, then comes the layer 3. Layer 3 is your kids' expenses and your kids' educational goals and other goals like kids' marriage, kids' education, running expenses of the kids, so on and so forth. So that's the layer 3. Okay.
Correct.
And after that, for certain set of people, there could be layer 4, which could be expenses of their parents. A lot of times you have families who have dependent parents on them. So these is assume it like a 4-layer pyramid, right? Now,
Right.
as your life progresses, your upper 3 layers, which is your EMIs and your childhood, your kids' expenses, your parental expenses, initially would balloon, right? Your EMIs would keep on increasing. You would take a home loan, and then you would take a car loan, and then you would take some other loan. Somebody's child is going for education, child loan, and then after that, your kids' expenses would increase. They are in first standard, they are in second standard, they are in 10th standard, they are going for engineering, medical,
Right.
you could be going for masters. So first of all, these are your expenses. Okay. Now, when you talk about financial independence, you have to understand that financial independence can come only and only when your top 3 layers are generally not available there because they are finished. For example, I can say that I have 0 EMIs. Okay. So second layer of mine is finished now. I don't have any EMIs. I don't need to pay any EMIs. Third layer of mine, which is kids' expenses. So for example, I can say, okay, my kids are now 18 or 16 or 15, and I have enough for them, taken care for them, and they can be what do you say? They can do their education. All those things can be taken care. That this kid wants to do a startup, that can be done. So that all I have managed. Okay, parental expenses, obviously they keep on going low because then you don't need to spend that much on your parents if they have a right insurance. So they
Correct.
slowly, when you progress in your life, your other 3 expenses will start first initially go up, and they will go down, right? Your one set of expenses which never will go away, which is your basic expenses, household expenses, the bottommost layer. Now, a lot of people need to understand that that particular layer will have a significant inflation, which they have to manage after financial independence. And that inflation is 6%, you can assume general inflation, and 4 to 5%, you can assume lifestyle inflation. For example, till some time back, you were driving let's say 10 lakh rupee car. Now you want to drive a 25 lakh rupee car. So that expenses will be there, right? So first things first, break down your expenses into these parts. Second, a lot of people get fussy about medical inflation. I think you should be fussy about, but it should never become a part of your cost. You should have the most wonderful health insurance with you. Just to give you a perspective, I have a personal health insurance of 2 crore rupees, family floater. Okay.
Oh, wonderful.
Yeah. So now when I realize that, okay, fine, on all circumstances possible which can go wrong with me, I am covered with a 2 crore medical insurance. Then I don't need to worry about my medical, costs. Yeah, general stuff, some medicine or something, some protein powders nowadays, all the things is okay. But generally, I don't need to worry about bigger expenses or some unforeseen expenses because I'm well covered with insurance. So that is my protection layer against medical inflation. School inflation, obviously, you are bearing it till the time your kid is going to the school. So that you have to bear. Educational inflation is also real and it is very high. So that you will keep on bearing, and you will create some corpus for them when they want to go for medical or they want to go for engineering or those kind of things. Right. So this is how you have to structure your FIRE number. Now, once you are free of your top 3 expenses, the parents'
Correct.
expenses, the kids' expenses, and the EMIs, the basic expenses you have to forecast for the next 15 to 20 years. Okay. So you assume that within this 20 years, you will get rid of every other expense. And next, after 15 to 20 years, you will be left with this particular expense. So for example, if my household expense is 50,000 rupees today, which does not include the upper 3 layers, this 50,000
Right.
is purely my household expenses. After 10 years, this will become 1 lakh, and after 20 years, this will become 2 lakhs. Okay. So now I have to plan for 2 lakhs. But after 20 years, let's say today I'm 30, my age becomes 50.
Correct.
Okay. So if my age is 50 and I will forecast this 2 lakh rupees and I believe that I'm going to stay till 80, I don't actually need a 30 times multiple because my corpus in the worst case scenario will still earn me anywhere between 4 to 5% per year.
Oh,
So
Yes,
a
true.
lot of people are fussing. I saw a podcast where somebody came and said 40 crores. The moment people
Yes,
listen to 40 crores, it is impossible for them even to fathom that they will ever become financially independent in their lives.
very true.
So I think people are fussing a lot about a bigger number. I became financially independent with a corpus of 5 to 6 crore rupees. And I'm telling you, the person who has capability of generating 5 to 6 crores in 15 to 20 years of their lives are people who will not be without any work after they become financially independent. They may be without a job, but they may
Right.
not be without a work. They will be having some freelancing, something or the other, which will keep on keeping them busy. And that is why I tell people don't fuss a lot about, a bigger number like 10, 20 crores. Just focus that your forecasted expenses, your household expenses, should be covered at least 20 times for you to become financially free. So if I am going to spend 24 lakhs after 15 to 20 years, I would rather be having a 5 crore rupee corpus, which is enough for me to take care of myself.
Okay.
After that, again, the assumption is that my EMIs are over, my kids have kind of educated, I have a little
All other
separate
layers are
corpus for
over.
them, I have a 1 crore separate corpus for them for their graduation, post graduation. My requirement at a 50,000 household expense is not beyond let's say 5 odd crore rupees. 5 odd crore rupees is a perfect number to become financially independent after 15 to 20 years if your present household expenses without the top three layers is 50,000 rupees.
Wonderfully captured, Sanjay. In fact, I think one of the most important takeaways for me over here has been that it is going to be basically dependent on the person's lifestyle itself. Like
Absolutely.
where exactly in the entire journey the person is staying. Now, there might be ding couples who might not have children there, for example. There
Mm.
might be people who want to retire early. And so basically, they might not look at future expenses in terms of marriages or other things. And when it comes to health, of course, the health insurance, which you rightly mentioned. Sanjay, a
Mm.
follow up question to this has been that the 40 crore thing, which just went viral a lot, I think there are two elements to it which we want to understand. One, I believe it kind of becomes a misnomer to us because it is, say, 20 years down the line. So the worth of 40 crore then might be actually much different than what it is in today's NPV terms, right? So it
Mm.
may not actually be as gigantic as it sounds. It's maybe if we take a rule of 72 and if we assume a 10% return, every 7 years this amount is doubling. So if we are recalculating it backwards, that means 40 is half is 20 and 20 is half is 10 crores. So in the next 14, 15 years odd, which is the timeline which I think these people mentioned, it is 40 crores, which in today's terms becomes maybe around 8 to 9 odd crores. A figure much more realistically closer to what you mentioned in terms of 5, 6 crores, right? So
Mm.
then comes the next question that if we take any of this amount, the 25x, 30x multiple, or 5, 6 crore in today's term, a very important factor that comes into mind for people is that what happens in terms of sequence of returns risk. Now, they might retire at, say, 40 years of age, or 45 years of age, or 35 years of age with the designated capital which you've just mentioned. But
Mm.
what happens if they face an immediate 3 to 4 years of downturn like we've been seeing in the equity markets, etc., currently? And
Mm.
not everything can be put in fixed investments now, can they? So, what would be your approach here?
Can I share a calculator here? I think I can give a very good answer here.
Please do.
Sure.
Please do.
So, first of all, let me tell you the concept of sequence of returns. And the sequence of returns concept is very simple that you become the worst hit investor in your life. And the moment you plan to retire, that very moment, the market suddenly crashes by 10 to 20%. Okay. Now, first of all, let me clear this myth. And it is very important. Let's say we take a 15-15-15 rule that if somebody is investing 15,000 rupees for a 15-year period and the corpus compounds at 15% interest rate, it reaches to 1 crore rupees, right? That is the general mathematics. Now, imagine somebody who's investing, let's say, 1,80,000 for 15 years, which is 27 lakh rupees. The person has invested 27 lakh rupees and the value of that corpus today is 1 crore. Okay. Now, first of all, if there is a 20% crash, this 1 crore will go to 80 lakhs.
Correct.
Okay. Which is still significantly higher than what you have invested. So that's the first thing. So this is one thing which everybody needs to factor for. But now when you have 1 crore rupees, we use generally something known as the well and bucket strategy. Okay. And in the well and bucket strategy, we create this 1 crore well into multiple buckets, 5 to 6 buckets. And these 5 to 6 buckets are in the increasing order of the risk taken. So the first bucket which we take, okay, is let's say an arbitrage fund or a liquid fund. depending upon person's taxation purpose. Okay, so if the taxation is high, we will use arbitrage. If the taxation is close to zero, there is no active income, a liquid fund also does very well. So first level, we will take an arbitrage fund or this fund, liquid fund, and this basically it becomes your first cushion to start withdrawing. Now,
Okay.
how much should be there? At least your 3 years of expenses should be lying in the arbitrage fund. Okay. After that, the next level of bucket. The next bucket is where you have, let's say 40 to 50% equity or 50% debt, that kind of a model. Okay. So that bucket becomes your second bucket. Now, till the time you were consuming your first bucket, the second bucket was protected and compounding both, because there was a mix of equity and debt in that. Okay.
Right.
So now you reach to the second bucket, the value of the second bucket has increased by then. You now start withdrawing from that bucket. Okay. Then you have the third bucket, which could be a bit more higher equity, lower debt. And then you have the fourth, fifth, sixth bucket, which are higher on equity because you allow them the growth period. Now, let me put it in a very simple manner again. For example, out of this 1 crore, just hypothetically speaking, I put 50 lakhs in equity and 50 lakhs in debt. And I consume from the 50 lakhs of debt. The remaining 50 lakhs is compounding for, let's say, next 10 years. And 10 years, it gives me 14% returns. The value of that 50 lakhs will become 2 crores.
Right.
Because it will double 2 times. Now, just imagine you had 1 crore, you consumed 50 lakhs, and now you're sitting on 2 crores. Now, it sounds obviously very fancy. So, to prove that, we have developed a calculator. And I would like to share that calculator here with you.
Yeah, I can see it now.
So, this is well and bucket SWP. Let's say somebody, let's take a case where I said somebody's retiring at 5 lakh rupees, 5 crore rupees.
5 crores. Okay.
Okay, 1, 2, 3, 4, 5, 6, 7. And I said that this person wants to withdraw 2 lakh rupees for a period of, let's say, 25 years. And the annual step up is 5%. Okay. The first bracket is debt and liquid. I am assuming that I will be able to get only 6% returns in that. And when I'll withdraw, the balance corpus of my first bucket will also still get 6% returns. Bucket 2 is conservative hybrid. I will make, let's say, 7% returns. Withdrawal is 6%. Balanced advantage, I will make 9% return. The withdrawal again, I'll put it at 7%. Flexi cap is another bucket at 11%. The returns, withdrawal will be, let's say, 8% returns. Again, 11 and 8, 11 and 8. This is all equity.
Okay.
The bottom 3 is equity. And
Right.
top 3 is your debt. Now, just imagine here, I have put 70% of my money in debt, conservative hybrid, and balanced advantage. And 30% of my money is purely in equity. Now, just see the magic. I deployed a corpus of 5 crore rupees. Okay. My corpus duration is 25 years. I have withdrawn 12 crore rupees already from this. And still I'm left with 12.39 crores after a period of 25 years. Now, my terminal monthly SWP, that means I started withdrawing 2 lakh rupees. In the
Right.
25th year, I was withdrawing 6,77,000 rupees per month. Because I was stepping it up by 5% every year. And people fuss a lot about taxation. Here is the calculation of taxation. 95 lakh rupees taxation in the entire tenure.
Oh, wonderful.
Okay. So that means only 7.9% is my tax drag. And
Okay.
my post-tax distribution comes at 11 crore rupees. Okay.
Correct.
And this is the explanation that if the market goes up by 3%, if my assumption goes up by 3% returns, my legacy capital will, instead of 12 crores, will be 41 crores.
Wow.
Okay. But if it is 3% less than my assumption, which is very difficult because more than 50-60% is already in debt.
In debt. Correct.
Yeah. Then also I will consume and I will not be able to leave anything, but I will be able to consume. So this is what gives you a complete picture of how your life will look like once you have started your SWP. Now just imagine after 25th year, will you be able to consume 6,77,000 a month?
Yeah, and I think that is where the question comes of inflation, right?
Mm.
Even the 11.95 crore today, it looks like a humongous number. But maybe 25 years hence, this might be annual CTCs of people at that point in time, like what we have today, right?
True.
Similarly, 6 lakh 77 might look like, a regular 60-70% expense of a salary of, say, around 10 lakh, somebody would be getting 25 years hence. So
Mm.
I understand it is very difficult to fathom this big number in today's terms and age, because in today's terms, 12 crore becomes around 50 crores 20 years hence, right?
Yes.
So this 11 crores actually means 3 crores today from a
Mm.
context perspective. And
Uh,
even that is a significant amount if you are leaving that kind of an
So
amount
this is
for, say, the next
yeah. So
20.
12 crores.
Yeah,
Yeah, you can say 12 crores after 25 years. If we
correct.
take basically every because see now what happens is you don't have any luxury lifestyle major lifestyle expenses at that time.
Right,
You
right.
have retired. You are financially independent. Okay, there are a lot of expenses which will cut down
True,
after
very true.
because see, let's say somebody retires at 50, right? Now just imagine at 70, 75, will they be able to consume this much? Their consumption levels also goes down.
Right, very true.
Okay, so that is and we have considered very very conservative numbers here,
Very true.
and
That's true. Because
70%
over
we have put
here,
in debt.
yeah.
Just imagine if I change this number a bit more, and I build in, let's say 20% I get here. Okay, just if I go a little more aggressive and instead of this 10% here, and in this bucket I will reduce 5%. In this bucket I'll reduce 10%, and in this bucket I'll reduce another 5%. Now let's look at what happens. Okay, your corpus balance corpus goes at 16 crore rupees
16
because your
crores.
withdrawal you
Correct.
have still kept the same.
Correct. Correct.
Okay, and in the third scenario, even if the returns go down by 3%, you are able to survive through and leave some money for your kids here.
Wonderful.
And see, I'll tell you my personal example. When I became financially independent at 39, today, just few days back, I turned 42. It's 3 years now, and I have not seen a very, very significant jump in my expenses. Okay.
But
And
do you feel that's a conscious decision from your end, or do you feel that even now you're living the same kind of lifestyle which you were living 3 years before,
I think,
and despite that, you are still at similar expenses?
see, I think I'm living a better lifestyle right now. Okay.
Okay.
And but my expenses have not gone up significantly. Segmentally, my inflation would have changed a bit,
Correct.
right? But all other things, it's not like food has become 5 times expensive, 3 times expensive,
Right.
2 times expensive. So I'm able to take care of my expenses. And as I said, people who have the capability to generate 5 to 6 crore rupees in corpus, that means they are extremely disciplined, they are high on skills, okay, and they're adaptable. Okay. So such kind of people will never stay without any active income even after financial independence, because see I don't use the word retirement. I hate retirement. My calculator is not called FIRE calculator. It is called fiber calculator, which is
Oh, okay.
financial independence before a retirement.
Retirement.
Okay.
Okay.
Because I believe there is nothing called as retirement. It's a very middle class trap which has been said to us that you have to, everything is bucketized. 22 tak padhai karo, and then you work for 30-40 years and then you retire. Why?
Correct.
And I think that has changed, and that will significantly change with the advent of AI and the way the job markets are going. People will become one person independent businessmen,
Right.
and there'll be a lot of opportunities to give those services to people.
Correct. Correct. So, Sanjayji, moving on, we also have a ton of folks in our early 20s, which you just mentioned right now. One of them, the Reddit user, the Dank1 underscore, he dropped a really sincere post and he asked, look, I'm just beginning my career and I want to get oriented without getting overwhelmed. If you were back in your early 20s today with a clean slate, what exact roadmap would you follow step by step for someone who's in the early 20s? If you could give a brief answer to this.
I think I will use a 3-step framework for my what do you say, super growth. Okay. The step one is, and which no Indian focuses on, is step one is protection. Focus on protection. Okay. Tie your seat belts. Have your emergency fund set away with you right now. Okay. Have your medical insurance set away right now. Term insurance you may not require early if you don't have dependencies, you don't have debt. Okay. But first of
Okay.
all, just tie down yourself in terms of having the right amount of emergency fund and right amount of health insurance.
Right.
Okay.
And what would be
Assume
that
this is
right
your
amount
first
for
emergency fund.
emergency
When you're
funds?
young, I think even 6 months of your monthly expenses is a good number to have in a fixed deposit or in a liquid fund.
All right.
Okay. And that is first. That's so protection is the level one. Now you will assume that after protection, I will say paisa SIP mein dalo.
Correct.
Okay. No. L2, very, very important. Very, very important is self growth. You have to accelerate your active income
Okay.
because people are focusing so much on which stock to buy, which mutual fund to buy. A stock will go up by, let's say, 5 times in 5 years in a best case, right? A
Yes.
mutual fund will give you 12% CAGR, but your self growth can give you like 500% CAGR for the next 5 years. You
Very
can
true.
start
Very
at a 30,
powerful.
40,000 rupee salary and you can reach 2 lakh rupee salary in no time, right? There
Very
is
true.
no upward cap on this, your active income. So
Correct.
I believe, and I used to do this, and today I feel I used to invest a lot less on my personal growth. I used to invest 5% of my income.
Oh, okay.
So whatever paycheck you make, 5% of that should go to your self growth. This could be courses, this could be meetings, this could be conferences, this could be networking events, right?
Okay.
This could be one-on-one meetings with your mentors. Pay that money. Pay that money. Don't say the other guy is making money, and he's scamming us. He's not scamming you. He has lived it.
Right.
People are ready to pay $1 million to have dinner with Warren Buffett.
Very true.
True. So why? Because they know that the moment you sit in that aura, the moment that guy answers your questions, he gives you a path. Right? So second investment of yours should not be SIP, but it should be your self growth. Now you design whether it will be 5% of your income or 10% of your income, but it is compulsory. Right? See, any good business, how does it grow? It reinvests its profit.
Correct.
So your profit is coming from your salary.
Right.
So take a part of this salary and reinvest in yourself because you're the engine who's making that money.
You're your biggest asset.
You are your biggest asset. And I always say that
Correct.
investment in cash can anytime crash. But
Oh,
investment
very
in your
true.
brain will give you the highest gain.
Wonderful. Wonderfully
Okay.
put.
So that is second. And then obviously the third is to create a habit, to start a habit of investing long term, which could be starting into as simple as your index funds, Nifty 500, Nifty 50. You can look, if you want to take an extra risk, you can go for Nifty Mid Cap 150, Nifty Small Cap 250. Simple, normal investments could be from mutual funds or ETFs, your choice. Okay.
Okay.
So this is the 3 level at the age of 20 you should focus. First, protect yourself. Then accelerate your active income. And third is create a discipline to invest long term.
And now let's flip the coin. We actually have two users, you catch 206 and you price underscore 206. Both of them are saying, but what about people like us who haven't started at their 20s? What about those people like us who have started their FIRE journey in, say, early to mid 30s now? They have already 7 to 8 years or almost a decade, which has already gone past. And the clock for them is ticking. And they're asking, how does this strategy fundamentally change when your compounding window is now compressed by 10 years? How do we avoid falling into the trap of chasing reckless returns to make up for the lost time which we have gone with?
Got it. So for that, we'll again use a calculator because calculator is something which I think really works well. And here again, I will use my fiber calculator. I'll just share it on the screen here.
Because numbers don't lie.
Yeah. In Hindi we say beta झूठ बोल सकता है, data झूठ नहीं बोलता.
Correct.
Okay, now let's look at this person. Okay, this is a fiber number and this is not a calculator, it is a GPS. Like when you open Google Maps, you put the map fetches your existing location, you give it a desired location, and then it gives you a path, right? So this is similar to that. Now you say the layer one expenses of yours today are 50,000 rupees. Your current age is 30, age of 30. Your target fiber is that you want to become financially free by 50. I take general inflation at 6% and I take lifestyle inflation at 3% every year. So let's say 9%.
All right.
Okay. Oh, so sorry. This comes to 3%. Perfect. Now, the rule is very simple and you will see this is auto calculated. Your minimum SIP step up should be 9%.
Okay.
So that you can beat the general inflation and lifestyle inflation.
So you're matching them basically,
Yes.
general and lifestyle.
It can't be less. It shouldn't be less. It should be more or at least equal. Okay.
Okay.
Do you have any lump sum investment today? If not, let us keep it to zero. And when your time frame is longer, let's say it's 20 years, we can take a good 12 to 30, even we can take 13% returns here. Okay. So your fiber target, it's 25 times of the requirement as of now in this calculator. So your fiber target becomes 8 crore 40 lakh rupees.
Okay.
Now just imagine you only require 40,000 rupees to reach there. So you start with 40,000, you step it up by 9% every year, you will reach to your fiber goal in 20 years. However, if you have to retire in 10 years.
Right.
Okay, if you want to retire you want to become financially independent in 15 years now, let's say. So I made this slider which gives you the entire exact answer. The 40,000 becomes 62,000.
Oh, all right.
Okay, but if you want to become financially independent in 10 years, the slider goes till 13 only here. 13. Then you have to invest 81,000 rupees. Now that means for the 7-year loss, your investment is doubling.
Correct.
Okay, for 7-year loss, your investment has doubled. We have one more slider here. I'll get it back to 20 years. So now a lot of people can say, sir, but we don't even have 41,000 rupees. Okay, I can invest only 30,000. Let's say, no problem. We'll go to 30,000. In that case, your financial independence goal will be achieved in next 25 years.
Okay.
So now it is your choice. Right. What do you want to do with this? Do you want to invest more? Do you want to invest less? That is now your choice. But the moment, let's say you say that this is, let's say 20 years back here, and you say, but sir, I have another 5 lakh rupees lying with me, which I'm not sure it is, apart from my emergency fund. Your immediate investment goes down from 40,000 to 38,000. Because that is also deployed again. Right? So this is the mathematics. This is as simple as that. Now, there's a new person who's now 40 years old.
Correct.
Okay, and he wants to become financially independent in 50. So now look at his problem statement. His problem statement is he has to start with 99,000 rupees.
Oh, that's quite significant.
But his financial independence target has gone down because he's spending 50,000 and he's only going to wait for 10 years.
10 years.
But now look at the magic here. Somebody who's 20 years old and he wants to become fiber at 50. His retirement number is 20 crores. Correct. But his investment is only 19,000 rupees.
19,000. Yeah. That's where compounding kicks in.
Absolutely. Basically. So don't chase extra returns. Don't chase extra returns. Okay, I'll show you another thing. Okay, a lot of people fuss about returns. Fine. Let's look at another case here. Let's take somebody is able to invest only for, let's say his age is 45 today. And he wants to become financially independent by the age of 50.
Correct.
Okay, 5 years. The target is 2.3 crores. He needs to invest 2,23,000 a month. Okay. Wow. Now he says, no, but I want to invest in something which gives great returns, not 13%, but 18% returns. Okay, so let's move the slider from 13 to 18. The answer becomes 1,93,000 rupees.
1,93,000.
Okay, so he is able to save 30,000 rupees investment. He is able to save 30,000. So the number difference is 30,000 rupees. But which is only 14% of what he had to invest. But for that, he's taking such an extra risk that if instead of 18%, because of that risk, the returns remain only 9%, then in that case, he will not be able to achieve his goal. He will miss the goal by 60,000 rupees a month, which you can compound for 5 years. You will understand the answer. So again, I want to be very, very clear that the tolerance of risk only increases by time. Don't fuss about creating extra returns for a shorter time window. It actually doesn't matter much. But for that incremental 3%, the kind of risk you take, and if you're not able to get the benefits of those risks in a short span of 4 to 5 years, in that case, you will be obviously in a soup. And I will give you a live example of this. Okay, I'll give you a live example of this. Again, I will share. See, till the time you don't understand how data works, it will be very difficult for you to fathom what I'm saying. Okay, just let me show you something very, very cool right now. And all to my Reddit community, because I really want all of you to be very, very educated. Now, this is, you have to give me half a minute to open that. Thanks, Nikki. And this is my absolute honor to be talking to the community, because I want everybody to be extremely clear. So 1 minute, here we go.
Trust us, sir. The honor is entirely ours. In fact, we are so obliged that you are giving us your special time. That too on an Independence Day. Speaking about financial independence, I think what better day than this?
True, true. So see, this is Nifty 50 chart. Okay, Nifty 50 index you can see here, and
Right.
you can see that today it has closed at 24,366. Okay, the value today of Nifty 50 is 24,366. That's 14th
Right.
August, because 15th August the markets are not on. Okay,
Correct.
how much again? 24,366.
366.
Let's go to 15th August 2025. What is the value?
20.
This is 14th August
Yeah.
24.
Again.
How much?
24,518.
24,631.
Oh, wow.
Yeah, 24,631. You can see here on the top. See,
Right.
there is here you should see here. This is okay. This is the one. So see here again, and 24,631.
631.
How much was it on after 1 year now? Same.
Just similar answer.
Pretty
Yeah.
much
I
same.
mean, 1 year gone, no returns at all.
Okay. Now let's go to 2024. August. What is the answer here? 24.
143, 139, somewhere in that range. Wow.
So last
So
2 years have been zero returns. I've shown
zero
you with
returns.
proof. 15th August, 15th August, 15th August. Okay.
Correct. Very
Now, what I want to establish with this is, everybody says do an SIP in Nifty 50. Okay. Now let's imagine a person thought that I will invest 1 lakh rupee in Nifty 50, and after 2 years, I will be sitting on 1,25,000 rupees. Why? Because I will make 12% every year and I will compound. So
12%
let's say
every year.
1,25,000
Correct.
rupees. This guy wanted 1,25,000 rupees after 2 years, and he deployed it in Nifty 50.
Right.
Did he achieve his goal?
Not really.
He couldn't achieve his goal. Okay.
True.
Why? Because 2 years market didn't give you returns. But what you did
Right.
was you looked at the past 3 years and you said, my goodness, Nifty 50 gives 15% per year, 14% per year.
Very true. Very
You have to
true.
understand.
Because of the COVID rally.
Yes. You have to understand volatility. You have to understand the nature of the asset. What if this person had invested in an arbitrage fund? The same 1,25,000 which he wanted could have been achieved with an investment of 1,10,000 rupees.
Right. 6%
So
odd
effectively,
return.
to save that 10,000 rupees, he actually didn't achieve his goal, and that is the problem which investors have. That
Very
they
true.
don't look at suitability of the asset. For a 2-year horizon, you cannot invest in equity. And you ended up investing in Nifty 50, the top 50 companies of India, which gave you zero returns over a span of 2 years.
Very insightful.
Thanks so
Definitely.
Let's go to the next one.
The next one I think we have is a classic case of what I call portfolio clutter syndrome. This is because we have a Reddit user, Impressive Agency 12, who is 25 years old today. He's earning well, by the way. He's earning 1 lakh a month and already has a 16 lakhs net worth to his name at an age of 25. He
Very good.
says that they have money scattered across Indian stocks, US stocks, space ETFs, gold ETFs, platinum ETFs, real estate with zero designated style. They want to know, how can a 25-year-old actually structure a clean asset allocation split for the next 10 years, and should they increase their SIP even when markets like the Indian markets which you just mentioned feel expensive and have not been giving any returns for the last 2 years?
Very good question. See, when you invest for a span of 10 to 15 years, okay, you don't get bothered by 2-year returns. Now I'm coming on the second side. So
Right.
earlier I said you should be bothered, but you should be bothered when your goal is 2 years, 3 years. Okay, but when your goal is 10 to 15 years, don't get bothered, because this is the time when you're going to accumulate extra units. And these units will give you good returns after, let's say, 4, 5, 6, 7 years.
Right.
And you have that kind of horizon. So that's not a problem. If I am having a viewpoint of 10 to 15 years, okay, I will definitely have a strong asset allocation. In terms of, large cap, I would stick to only 20% large cap.
Okay.
In mid cap, I will go at least 30 to 40%. Okay. Small cap, I'll go 30%. 10% I will go in gold and silver combined.
Correct.
Okay, and a lot of mutual funds there are which you can have an exposure to gold and silver combined. Okay, and let's say 10 odd percent at least in international equity through Nasdaq 100 or S&P 500 or emerging markets
Right.
index or through all capital world index ACWI. So we can have this.
Right.
And trust me, you don't need 40 mutual funds. You actually need only
Right.
4 to 5 mutual funds to make you very successful. So focus on India market. See, if again, I'll show you with data. I showed you Nifty 50, Nifty 50. If you look at Nifty 50 again, I'll show you. Use monthly candle here to show you something very interesting. Now, see, this is the line I have drawn here. This is September 2024. Okay, 2 years back. Nifty
Right.
started falling and went down till here. It again came back and touched its all-time high. It came down and it is still here. So I can say
Correct.
somebody who had invested in September 2024 is down by 8% right now also. Okay.
Correct.
So this is your top 50 companies of India. But now
Right.
let's come to the mid cap sector. Nifty mid cap 150. Okay. Now when I look at this, somebody who had invested in September 2024 here
Right.
today is up by at least 4.32%. So mid cap companies have a faster chance to recover.
Right.
Right? If I look at small cap, okay. Again, see, small cap has also almost recovered.
Right.
It had fallen significantly, okay? Obviously, because small cap is extremely volatile, it had fallen to almost 30%. But from its bottom, it is already almost up. Hardly 1% is remaining to reach its all-time high. So what I mean to say here is that if you have a long-term view of 8 to 10 years, then you should not look at only large cap, because large cap will give you slow growth
Right.
and slow recoveries. So focus on having more exposure towards mid cap and small cap. Don't go beyond the top 500 companies of India. Okay, stick to the Nifty 500 index in terms of 100 large cap, 150 mid cap, and 250 small cap. Stick to this and allocate more towards mid cap and small cap. Allocate bit towards international and 10% in gold and silver. I think you really don't require anything after that.
Okay. And sir, just on that thought, two questions which I have as a follow-up is, when you say that small cap and mid cap can actually recover faster and they have a potential to have maybe, better returns as compared to large cap in such durations. At the same point of time, of course, they are riskier as well, as per your own sheet, which you just mentioned. Do you feel that this SEBI's new investment class called SIFs, where they're also using some 25% of derivatives, etc., to leverage these downturns or to give more returns depending on the fund's philosophy, do you feel these can actually bring in more value to people? Should they invest, or should they first have a say net worth of some X amount, after which they should consider doing this?
See, I always tell people, for any exotic product, okay, apart from mutual funds and ETFs, anything is exotic for me,
Okay.
because then a human has come into picture and he's trying to do something,
Right.
right? So L1 exotic product is SIF, which is specialized investment fund. Till the time you don't have a net worth of minimum 1 crore rupees, please don't dabble into it. Second, the history is very small right now.
Right.
I don't have enough to say that this works or this doesn't work. Inside the launched SIF schemes, I can show you how many of them have underperformed Nifty 500 and some have really outperformed Nifty 500.
Okay.
But it's very short time for me to take a judgmental call on them.
All right.
Second, I will say don't go beyond till the time you're not like 1 crore plus on your total portfolio. Then you can say, "Okay, I'm experimenting only with 10% of my portfolio."
Right.
Right? If you want to invest in PMS, which is portfolio management services, your net worth should be minimum approximately 3 crore rupees.
Okay.
Okay, and if you want to invest in AIF, which is 1 crore minimum ticket size,
Correct.
your net worth has to be minimum 10 crore rupees, because this 1 crore is going to be stuck for the next 6 to 7 years.
Right.
You'll have zero access to that money. So please don't look at exotic products. Exotic products are meant for the AMCs and the fund managers to make money.
Just on that note, I think there was one clarification also which SEBI had recently published. They said that for people who wish to invest in AIFs or such alternative investment funds, they need to first endorse themselves as accredited investors from their CAs. because if they don't have a net worth of less than 5 crores, or if they have a combined net worth of less than some 3.5 odd crores, the numbers can be checked by your finance advisor. They are actually not allowed from this 1st July onwards to directly invest into AIFs or even into vehicles investing into AIFs. And I think this is the logic now that you have explained it, that at relatively lesser net worth, it's a very risky profile to actually go with. So, got
Absolutely.
your point, fair and square.
See, again, it's everything in life you should do, but it should be rule based. Like in 70s, you can't eat oily stuff. It's a rule. You would love to eat, obviously, it's amazing, right? But you shouldn't eat because it's not good for your health. Similarly, having an asset which is tied up for 7 years, which is high risk, which invests in private companies, it is a great product for somebody having a 10 crore, 20 crore net worth. But it is not a great product for somebody having a 2 crore net worth, 3 crore net worth, because 50% of that person's net worth is now stuck in a company, stuck in a asset which is absolutely illiquid.
Right. So this includes your private equity as well, I'm assuming,
Absolutely.
right? The unlisted stocks.
Unlisted
Right.
stocks also, yes.
Correct. Right. So you did mention about international equity, Sanjay sir, and I think it is there that we have our next question from our Reddit users, UT2X39 and Impressive Agency 12 again. They're saying that when it comes to macroeconomics, they have a huge dilemma with foreign markets like US performing so well, but Indian tax laws tightening on foreign funds and LRS becoming cumbersome. Does international diversification still make mathematical sense? And more importantly, should Indians track their net worth in USD or INR given the recent rupee depreciation that has been happening for the last 1 year?
Again, very, very good question. I think, I should compliment the Reddit community for asking such intelligent questions. See, rupee going down will definitely impact us. Okay, because we are net importers today, as we said, and
Correct.
as an investor, see, there are different types of investor. Okay, if there is a very small investor, I think his life will not majorly change because of all these things. But if you feel that you want to send your kids abroad for education, you want to settle abroad, you want to buy something which is outside of India, then obviously these things do matter to you, right? And to that tune, your money should be lying in assets which are dollar denominated. Okay. So, be it US stocks, be it US ETFs, be it, houses which can give you dollar rentals, anything which suits you as a product, there should be a part of your investment which can be lying in that. But having said that, bulk of your life, if it is going to go in India, then don't focus on, just my net worth, what is in dollar terms, right? Because if your bulk of your life is in India, then how does it matter majorly? Only to the tune of the money which you really want to send abroad is something which you can diversify in international ETFs. Definitely, there is a cap. Now, there were three ways to invest. One was through Indian mutual funds normally or ETFs,
Right.
where the cap has been reached. Second is through Gift City, but the options are very less. But then third is from your Gift City brokers, or directly you can invest through LRS. You can invest up to $250,000 per PAN card per year. And I think that is a good choice to do. And there are a lot of good platforms today which are able to, where you are able to buy these kind of things. And I think you should start investing abroad. And could it be as simple as Nasdaq 100 or S&P 500 or emerging markets or all capital world index? Because you have to understand, from a diversification standpoint, Indian market as a proportion of the total global markets is only 3%. So out of 100 rupees of total assets, only 3 rupees are lying in India. 97 rupees are outside.
97 are outside.
Outside.
Right.
So it gives you a good exposure to different kind of companies, and obviously you can create a portfolio there.
All right. So we'd like to drill this down further because this is a major theme and a lot of questions have come on this. Now, the question which comes next is that if there is a big dilemma, if you want to invest through mutual funds which are domiciled in India but are investing in international equity, then in that case, first of all, there are limits which have been imposed by RBI with regards to $8 billion total limit that is already there, which most of the mutual fund houses have hit, and they are not taking any fresh
Other.
investments, at least not on a lump sum level. They are taking at SIPs which are already existing. So these people don't have a means to directly go into these funds. The second option which was figured out out was that you invest to the India domiciled foreign ETFs. Like, for example, this is not a recommendation, by the way, but Motilal Oswal's Nasdaq 100 ETF listed on
Second,
NSE. Similarly,
Arm tech हो
S&P
गया.
500 ETFs listed on NSD. Correct, correct. But the problem which they find out there is that the indicative NAV, which we get in terms of the underlying stocks of US markets or the international market which these funds claim to represent, that is at a significant discount from the trading price of ETFs in Indian markets. So essentially we are paying a higher premium just to get the same number of units of these international stocks or ETFs because they are listed in India and because of the relatively capping on the supply side because of RBI limits. So that becomes another issue for
True.
them. The third, which you mentioned, which was about the LRS scheme, if we go directly through Indian, brokers who have their tie-ups internationally, or if we go through Gift City, all of them have a lot of tax compliances, which is with regards
Hmm.
to the various filings, the foreign assets, and all of that as well. And Gift City is an altogether different behemoth to discuss separately. So first of all, amongst these 3-4 options which we have, do you feel that it is worth the effort in terms of the cost benefit analysis of the kind of compliances that you need to do in order to actually go through LRS routes, or should one invest in India domiciled ETFs, etc., and pay a premium instead?
See, first of all, you will not get units of Indian domiciled ETFs now very easily because there is a supply side issue.
Mm-hmm.
Okay, most of the days when you look at these ETFs, there is no supply. There are buyers, but there are no sellers. And you are just one news away from uh, washing out this entire premium. If tomorrow, though the probability is low because Indian government doesn't want Indian mutual funds to spend dollars, but let's say hypothetically, if mutual fund industry or ETF industry is able to kind of lobby and get this done, and the government says, okay,
Right.
we are increasing the limits to, let's say, $20 billion or $15 billion, that very moment your premium of an NAV will crash significantly. Okay, and that's one risk which you are taking. So now the choice is yours. Do you want to take that risk and have an illiquid state where every day you punch an order and you still don't get the unit? That is one. And second is that you say, okay, fine, I will take a bit of hassle. And there are so many Indian portals which are simplifying your LRS, your TCS, your Schedule FA, foreign assets. It's become very simple. And you can pay your chartered accountant, let's say, $1,000 more, and he can obviously add this to your portfolio. So I think the choice becomes very clear for me. If you really want to invest and your investment horizon is at least, let's say $100-$200 a month, you want to invest in an SIP, through this LRS, I think it's a good call. I think, and you can take it and maybe just spend an extra $1,000 for your compliance on these kind of assets.
So compliance would be the direct cost, which we are just mentioning in terms of the additional 1,000 rupees which you're spending on to the
Absolutely.
CA. But more than that, I think what people also want to understand is that if they invest, say, through LRS into ETFs which are listed abroad, then in that case, the dividend distribution, all the other things which happen in these global markets, they would be taxed by these foreign countries, and that would be done, to our understanding, and you can of course give us more clarity on this, at the fund house level. So the individual would actually be paying tax also in the foreign country, and still, because it is being taxed on a fund level, not getting a DTA benefit into Indian taxation so that he can take credit out of that as well. Then in that case, do you feel that the hidden cost becomes significantly higher when you come to these instruments as compared to maybe a listed Indian ETF at, say, 10% premium or a 15% premium?
See, again, I believe that again the illiquidity in itself is a big problem. Now, I remember I was trying to acquire Mahak Tech units,
Correct.
okay, which is China Tech, Mirai Asset. Again, no recommendation, just a case in point. And I
Right.
saw that I couldn't acquire the units, and I
Right.
lost the rally of 15%. Okay, now what happens is this is penny wise, pound foolish. If I believe in an asset and that asset is going to go up 2 times in, let's say, next 5 to 6 years, and if that is my belief, then why should I worry about these little dividends? Got it? And as it is dividends, foreign countries will tax you at 25%. And if your income tax bracket is in that level, you will get a rebate of that money which has been deducted. And if your income tax is not in that level, you will lose that 25%. So forget that you got lesser, you just got lesser 25%. Second, there will be no fund management fees at that level. right? There'll be no cost then. So I think and this is a classic mistake which all investors make. Not only here, they will say, "Nee, I will do myself because I will want to save brokerage, I want to save this, I want to save that." But
Right.
till the time you don't understand, you're investing for a larger gain. You're investing for 2 times in 5 years, 2 times in 6 years. Let's say 5 times in 10 years. That's your view. If that's your view, then why are you fussing about little expenses? So I think that is my stand. I personally invest through. I don't have single international ETF now in my portfolio. My entire
Okay.
portfolio is done through LRS.
Okay.
100% of whatever I invest in global markets, I invest through LRS, and I feel it's very comfortable for me. And the kind of frictionless investing I can do, I can buy, I can sell, I can, buy today, sell tomorrow. There is no problem. The order gets executed within a jiffy, and all is set. The only issue is obviously once you transfer some money, right? You will have to pay some charges. But again, as I said, if you are only going to invest, let's say 100, 200, 500 rupees or 1000, 2000 rupees, don't do this. You get into
Right.
this play only when your investment is at least 150, $200 per month basis. Then it makes a bit of
Right.
sense for you, right?
Okay. All right. And then in that case, basically what you're saying is it's better to rather invest in direct stocks, because then all the dividends, etc., you can anyways claim the double taxation avoidance agreement benefits of taxation in India for the
Yeah, you
same
can invest
taxes
in
which you
ETFs
gave
also.
when you.
You can invest in ETFs also. There's no problem.
Yeah, basically no mutual funds, only ETFs and direct stocks,
Yes.
because then your taxation will get claimed over here as well as a credit
See, I'll tell
to your
you,
Indian tax
the
liability.
moment you understand how international markets work, the kind of depth the
Right.
international market has, you
Right.
will fall in love with that investment. Because great, India is there and we are investing in mutual funds, but the kind of depth which international markets has
Right.
is just out of the world phenomenal. The kind of assets which they are able to give to you, the kind of things which they do, the kind of ETFs which they have. Today we are talking about SEBI coming up with this new category of mutual funds, which is what do you say, the mutual funds where it's time oriented. That you can plan for 10 years.
Correct.
These
Close ended.
ETFs are
Yeah.
available in US for so many years, right?
Right.
These are called life cycle funds in India, but if you
Life cycle
if you
funds.
search up BlackRock Life Path ETFs, so you can
Right.
decide you want to become financially independent in 2045. You can
Right.
decide you want to become
Right.
financially independent in 2035, and the entire asset allocation automatically moves that way, right?
Right.
So a lot of
Right.
products are there which in US and international markets are great. You can access the entire emerging economies. You can even, for example, like recently, all your memory companies had gone significantly up, right? And
Right.
they crashed
Right.
also. So there is an ETF only for memory companies. So if you feel
Okay.
that you can't identify the winners in memory play, then you can buy a memory ETF, which is not as volatile as memory stocks. If memory stocks are falling by 60%, the ETF will fall by 30%, 35%. So
Right.
the kind of product level innovation they have on finance in international markets is just out of the world phenomenal. And even if you don't invest, just go and if you're a savvy investor, you want to later on, maybe once you have some capital, you want to do it. I think it's very, very important to learn this also.
All right. And also, there was one last question on this, on the sides that some countries like the US also bring in an element of estate tax, etc. So, what happens is that you are thinking that you are making wealth for yourself or for your child to go and study abroad. And once you cross a threshold, we believe currently it is around $60,000 or so. If you cross that kind of a threshold, then, and God forbid you pass away, then in that case, I think certain countries like US also put in an estate tax, which can have very significant percentages of taxation on the overall portfolio rather than on the gains alone. So in order to deal with them, there are something called usage, etc. If you could just give us a little bit of an idea as to how can one better plan this, and what should be an approach now that we are talking about savvy international investors.
Okay, so let me put it this way. Obviously, you are right that there is an estate tax beyond $60,000 of holdings, not profits. So that also everybody has to remember. People think that we
Okay.
will make $60,000 profit and then we will be charged. No, your asset holding should be $60,000.
Correct.
Having said that,
Correct.
$60,000 is 60 lakh rupees. Okay, I don't know how many people in India have a
Right.
60 lakh rupee portfolio. So I think 99% or 95, at least 95% of the investors will be gone there only itself. And if you're talking about $100 average investment or a $200 per month average investment, neither will you hit the TCS
Right.
limits, which is above 10 lakh rupees, right? and neither will you hit the estate
Right.
tax payment till the time you're investing for 8 to 10 years.
Mm.
So that is one. So don't fuss a lot about estate tax if your investment is going to be 10,000 rupees a month or 20,000 rupees a month. It'll take you quite some time to reach to $60,000 levels, right? So that is my first advice. Second, if you're going to invest a larger capital, right, then in that case, you need to have a two-way approach. If you're doing stocks, you can do direct. If you feel that, I don't generally recommend doing direct stocks because it has a lot of complication. But if you
Right.
feel that you want to buy a Tesla or an Nvidia, no advices, but anything which you want to buy,
Right.
then you do it through your normal route because there is no usage for a direct stock. But if you're investing in ETFs, you're investing in
Right.
Nasdaq 100, S&P 500, you're investing in all world, you're investing in emerging markets or complete tech markets, or you want to invest in Europe, or you want to invest in LATAM, you want to invest all these places, go through UCITS ETFs. And
Okay.
UCITS ETFs, the nature is that they are domiciled out of America, which is broadly in Europe, Luxembourg, Ireland, UK, and they are euro denominated, they're local currency denominated, and there where you bypass the estate taxation. So they're not subject to estate taxation because the asset
Oh, wonderful.
is not domiciled in US. So when you do
Right.
ETFs, you can do UCITS ETFs, and when you do stocks, obviously you will have to do American listed stocks. That is the thing. And if you have a portfolio, like one of our clients had a portfolio of almost $3 million, which he had gathered over the last 30 years. And
Right.
he was in Singapore and he was shifting to another European country. So that time you need to get out of all the stocks and start moving to UCITS ETFs.
Right.
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 So you'll need to restructure your portfolio. A lot of people have RSUs. They also have to be very careful.
Yeah.
Because suddenly what happens is now you have $100,000 worth of RSUs, $200,000 worth of RSUs. So I always tell
Right.
people that put a part of this RSUs, take an SWP out of it and put it in UCITS ETFs. So this is how you see. It's all about the size of money. If the size of money is bigger,
Right.
then you have to manage it. Then the
Correct.
same approach
Correct.
doesn't work.
Right. Great. So coming back to India again, the next question is from Reddit user hot underscore standard 5562. He says that I'm a middle class earner in Mumbai where fixed expenses like rent and school fees feel completely uncontrollable today. How can someone like me realistically accelerate my FIRE journey? And how do you keep your sanity and emotions in check when the market swings wildly and inaction is the hardest thing to do?
My goodness, there are 2, 3 good questions here. First of all, see, you're in Mumbai, and if you're an average earner, I can only sympathize with you because this is a very, very, very expensive city, and especially on the rent front, I don't
Right.
see anything below, livable below 25, 30,000, 35,000 rent here. So
Right.
obviously a big part of your chunk will go there. And if your office is in other part of the city, then again, your travel costs will increase. Having said that, obviously, as I said, try to see how you can get multiple sources of income. Can you do some freelancing? Can you, create something for yourself where you get other income? So I think that is also very, very important for you to start improving your income, because see, expenses have a floor. They can't go below the number. Okay. Let's say you are spending 15,000 on grocery, you can get it down to 12,000, 10,000. But beyond that, it is not possible. Then you're not living properly, right? So
Right.
first way to accelerate your financial independence journey is to start earning more by reinvesting in your skills. Second is that you're talking about what happens when the market goes wild. See, market will go wild, and the job of the market is to go wild, right? It is not a defect; it's a feature of the market. And when it goes
The
wild,
future.
you get
Yeah.
good. You get opportunities. You get opportunities to buy lower also. But if you are not matched your requirement to the right asset class, then there is a problem. So asset
Right.
class comes first. Second, requirement comes first, right?
Right.
So your requirement has to be very clear. When do you require the money? How much risk can you take? Is that product suitable? Let's say, again, as I said, you want to invest for 2 years and you saw Nifty 50 last 2 years, zero returns. Worst could be
Right.
you wanted to invest for 2 years and you bought Bitcoin, right? So again,
Correct.
you're stuck. But if you are looking at a 10-year horizon, 15-year horizon, no problem. So suitability is very important to tackle volatility. The moment you understand this product is suitable for me, and let me tell you, the mutual fund industry in India has a product for everything. They have khichdi products, which is called hybrid.
Right.
If you look at the
Correct.
hybrid space, you have 7 different type of products in hybrid. Starting with 100% fixed income, in form of arbitrage
Hmm.
to going up to
Right.
25% fixed income, 75% fixed income in
Fixed
form of
income.
equity savings scheme. Okay,
Right.
not equity linked savings scheme, equity savings scheme, which has
Right.
25% equity and 75% fixed income. Then you have hybrid funds, which are 50-50 debt and equity. Then you have what do you say, balanced advantage funds, which are 65% equity, 35% debt. Then you have aggressive hybrid funds, which are in the range of 80% equity, 20% debt.
Right.
So now you have all types of assets available for you. You have to see what you require. So volatility is a function of suitability. If you have
Right.
identified the right product as per your requirement, you will never have an issue.
Wonderfully put.
And third
In
is
fact, he also, yeah.
third is also just delete the app after you start investing. Don't look at the app.
Right.
The moment you start looking at the app
Correct.
is the problem.
Correct, correct. And it also maybe gets a direct correlation to your blood pressure levels as well.
True, true.
Right. He, in fact, asked a very good follow up question to this as well. He says that I did everything what you just mentioned. And then after that, say I reach at a sizable corpus around, say, 40 to 50% of my FI target. Now, at this stage, if I start switching funds, it triggers massive capital gains tax. Do you recommend that instead of at that point of time when you start getting tempted with all your fancy exotic products like SIFs, P2P lending, etc., what should be the way forward now to navigate from here without blowing up their portfolio by giving humongous taxes at such a stage?
Good question. Change the new allocation. Don't change the old allocation, change the new allocation. For example, you have reached
Change
50%
the
of your FI
okay.
target, and now you feel that for the balance, I don't need so much aggressive equity. I want to have build a bit of fixed income. So let's say you had a 20,000 rupee SIP, which was 70% in 80% in equity, 20% in fixed income. You can now reset your SIP to
Right.
50% in equity and 50% in fixed income. So this saves you switching also, obviously, because switching is very expensive in India. You end up paying sometimes exit loads and you're paying taxes, 12.5% on long term. So this
Right.
it does become expensive. There's no doubt about that. So instead of switching, now your new allocation, you can move towards the product which you really want. And that's what I advise to all my clients or people who ask me questions is that you move your new allocation so that you can reach your desired allocation.
All right. In fact, on similar lines, we had another Reddit user, Imagination, who said that they already have 30x expenses earmarked, in which 10x is in their liquid or arbitrage fund,
Yeah,
and
nice.
100% of their equity allocation is already sitting in Parag Parikh FlexiCap fund. They explicitly said that I don't want blind fund recommendations. What criteria and managerial philosophy should I use to shortlist 2 3 complementary mid or small cap or multi asset fund to balance out this PPFCF's value tilt which I already have accumulated so far?
Sure, very good question. I think a very, very intelligent guy who has asked this question. If you look at Parag Parekh, he's right. It's a value-driven fund. Okay.
Correct.
What he's missing is momentum. Okay. So now he should add a bit of momentum-based either direct funds or AMCs which are focusing on momentum.
Correct.
Now this is very complicated to identify a momentum guy. So my advice will be go for factor indexes. There is a Nifty 500 Momentum 50. Okay, which cycles every 6 months and picks up 50 companies from the top 500 companies of India, which are in momentum.
Okay.
And if you want to really increase your risk, there is Nifty Midcap 150, Momentum 50, where the
Okay.
universe is Midcap 150. So every 6 months, the churning is happening from the midcap companies.
So here, if we understand correctly, there are two levels of risk. One is the mid cap inherent risk, and
Yep,
then the momentum risk over and above it.
absolutely.
Correct.
So this is then it becomes a bit more risky than your Nifty 500 because Nifty 500 will have large cap, mid cap, small cap, all three.
Right.
So, according to the risk which this person can take, he can select either a Nifty 500 midcap, what do you say, momentum 50, or he can select a Nifty midcap 150 momentum 50.
Okay.
And these are index funds, so they are low cost, and there is no fund manager sitting, so there is no bias.
Okay. In fact, I have a follow up question of my own on this. Right now, as we just discussed, I just heard somewhere that, if you compare small caps and mid caps in terms of their returns profile and everything, what happens is that the incremental return which you get in a small cap fund okay, is at a very high risk as compared to if you invest the same amount in a mid cap fund. So you'll get similar return even from a mid cap fund, but your risk adjusted return becomes much higher because these are relatively established companies. Do you feel that there is logic to this principle, or do you feel that this is just another gimmick?
No, it is pretty much logical, and that is why if you want to make a better extra return from Nifty small caps also, you can, instead of picking Nifty small cap 250, you can pick up Nifty small cap 100, which are the top 100
Okay.
companies of small cap. They are better on,
Okay.
in terms of market cap, they are close to mid cap. They will very soon enter mid cap. So that benefit you get from. So mid cap, yes, on a risk
All
profile,
right.
I believe mid cap is one of the most beautiful. Mid cap and Nifty next 50. They are
Right.
very good. What do you say? Indexes to own.
So basically, you're saying the 51st company till up to 250th company of the index. That is
Ah,
where your universe should be.
very
That
good.
is the
So this
perfect
is a
universe.
good risk also. You are taking risk, yes, but you are betting on companies which have the potential to go 5x, 10x,
Correct.
and which are not very low in terms of sizes, and which are like high risk. Because then if you're picking up a company which is in the 1,000, 5,000 crore range, you need to identify the inherent risks to that. There could be promoter pledging, there could be higher debt, there could be so many things which are not falling in the quality parameters, right? So, and that a normal investor can't do.
Okay. All right. In fact, talking on about sophisticated instruments, we had one of our Reddit users, Balu underscore cat. He asked that how should I, if I have to actually invest into this, how should I evaluate an AIF, and do they have any legitimate place inside a long-term retirement portfolio, or are they just expensive fee traps?
See, as I said, anything you go exotic, you end up making more money for
Right.
the AMC manager. Okay.
Right.
See, first, let us understand what each of this product offers. Mutual fund offers you direct investment into equity with different types of mixes. Perfect. This is public equity. Now I come to SIF.
Correct.
SIF gives me a little unique stuff, which is 25% FNO.
Correct.
So there is something unique to SIF. PMS, I
Right.
believe it's the most overhyped product, has nothing new to offer to us. Okay. And
Okay.
that is why I've never even recommended anyone a PMS, and neither do I own any PMS.
Okay.
And frankly speaking, I don't also own SIF, I don't own PMS, I don't own AIF. And my portfolio is still doing very well.
So keep it simple.
I see finance, people, there is nobody who's going to pay money for simplicity.
Correct.
And there are umpteen number of books written that you actually make money only in simplicity. Finance, making money in markets is a behavioral game. It is not anything else. You get your behavior
Right.
right, you will end up making money. Okay, so coming back, uh, so PMS has nothing to give you, nothing to give you, except high fees, high churn, high capital gains, and a disappointing return after some time. And there have been very significant fund managers wrote great books, came on stage and spoke very well, and their returns saw -10, -15%. So let's not look at AIF has something unique to give to you, which is access
Okay.
to private markets. Okay, which you can't do yourself. But this is a rich man's game. So don't go, as I said, 10 crore plus. Okay, it's like you buying a plot. अगर आप plot
Correct.
खरीदते हो, तो you understand that this plot has to be kept for 10 years. And then you say, okay, fine, I can't put all my money in the plot. So what I'll do is I'll put a 10 to 15% of my, let's say, net worth in the plot. Because if something
Okay.
happens tomorrow and by the time I require it, it doesn't sell, then I should not be stuck for money. I should not be asset rich and income poor. So AIF is a great product. There is no doubt about it. But it is suitable only to people who have more than 10 crores of net worth. And if you have a retirement corpus where you want to put it into AIF, only last leg of 10% of your corpus should be in AIF. Okay, because he understands it is very easy to say it's 14%, 18%, 22% post fee CAGR.
Right.
Everybody doesn't make it, first of all. Second, nobody has the patience to wait for 7 years.
Right.
So that you have to understand your behavior against this product.
So if we assume that this person actually had that kind of a portfolio, 10 crores and above, if we were to answer his query that how should he evaluate them, then what would you feel are the basic fundamental principles or, major areas which one should look into while evaluating things like AIFs or private equity for that
Talk
matter?
to at least 5 equity AIF managers.
Okay.
Attend their webinars, attend their calls.
Hmm.
Okay. Don't invest in AIF which are 100% public market AIF.
Okay.
Never,
Hmm.
ever. Because then you are actually, it is just replacing mutual funds within a high cost product.
Right.
Okay.
Hmm.
When you are looking at fund managers, understand their thesis. What are they selling you? And understand the risk in the thesis. Now, for example, there was an AIF which was a purely asset reconstruction AIF.
Okay.
Okay. So they would go and buy dead companies from
Hmm.
NCLT,
Right.
and then they would find the buyers for that company. They would restructure the company and sell it off.
So they were expecting turnarounds
Yeah, pure
basically of these
turnarounds.
companies.
Pure turnaround. Now, just
Okay.
imagine
Okay.
if a company has gone to NCLT, first of all, the probability of turnaround is very low.
Very low. Very
Okay.
low.
But then there are people who will get 100 rupee asset for 5 rupees also, 10 rupees also. But then you have to
Right.
liquidate that asset. So you have to understand the risk profile of this particular AIF. So this though I will not recommend to even a 10 crore net worth guy. I will say if you are 20 crores, go
Network
there.
guy. Okay.
But that
Okay.
AIF ended up giving 33% returns.
Wow.
Pre-fees. So if you would have reduced
Huh,
fees
of
and other
course.
things, it could have gone to 24, 25%, 23%, which is phenomenal. But again, the risk levels were high. So look at Cat 2 funds. Cat 2 funds, I think, have 35 or 40% limit where they can invest in what do you say, companies which are going to be listed. And they are going to be listed. So that means the risk is not significant. If
Okay.
company
So they're already done with their A series and all those kind of things. They're just pre-IPO stage they have already
Yes.
reached.
So that pre-IPO could be like as bad as NSE. NSE has not still come for IPO.
Correct.
So it
Correct.
could be as bad also if people are trading in NSE stocks for the last 7 years in the in the
Correct.
private markets. So that
Right.
could also be a problem statement. So but these fund managers will have a thesis. Somebody will say I am betting on energy. Somebody will say I am betting on consumption. Somebody will say no, I am multi asset. So you have to understand what they are doing. Please don't blindly invest in AIF just because your friend said so or because the returns were amazing in the last 3 years.
All right.
Okay, so
Wonderful.
look at what the thesis of the fund manager is, and then make the investment decision.
Great. So, Sanjay, we have another question from you, Faulty Towers. He says that, and he has actually pointed out the same stage which you just mentioned about asset rich but cash poor. So, his entire family, including himself, they own land, they have second flat, they have cars, but their entire monthly surplus, which they get over and above their expenses, is getting swallowed by high EMIs, but their kids' college fees is almost on the horizon. So, how do you integrate illiquid assets into FIRE math, and what is the step-by-step roadmap to liquidate such dead assets into cash-flowing investments? That is
Beautiful.
his question.
Very good question, and I really appreciate the clarity with the question with which the question is asked. See, illiquid assets are also assets. Okay,
Right.
what you do is you write down your goals, clear goals. That goal number one, my kid has to go for education 3 years down the line, and he requires, let's say, 30 lakh rupees. Second kid
Right.
goes to education after 6 years, requires this much. Make a goal sheet first. Okay? If you just imagine, what people are doing, what investors are doing today is it's like this. Just picture this: that there's the guy who wants to go somewhere. He goes down, he opens his Google Map app, and he stands there, and he's not giving Google the direction where he wants to go or the destination. So till the time you don't have a destination, you will never have a direction, right? So give the destination first, which is the goals. Then you attach
Right.
each asset to the goal. You say, okay, fine. After 3 years, I require 30 lakh rupees. There is a plot sitting somewhere which is 50 lakh rupees worth. So what I will do is after 3 years, after let's say 2.5 years, I will start the process of selling it, because any illiquid asset, you will have to give 3 to 6 months to sell it.
Scouting is hard.
Very hard, because else you will sell in desperation and you will not get the right amount for yourself.
Correct.
Okay. So you have to timelinely prepare for it. Second, if you feel after the goals also you are left with extreme estate, then you sit down and see which estate has kind of reached its potential. And ask a simple question: will this asset triple in 10 years? Okay. And don't give an emotional answer, give a logical answer. Why will it triple in 10 years? Now, triple in 10 years is 12% CAGR. or rather 11.2% CAGR. Okay, so you look at this particular mathematics, and if it fits into the bill of tripling after 10 years, you retain that. But if you see that asset is dead, it has kind of reached its pinnacle, there is no further development. Okay, now for example, if you look at Delhi, Chandni Chowk was the highest growing asset in 1980s and 90s. But if somebody would have invested in 2000s there and sitting it till today, there will be almost zero appreciation for that person. Right. So historically it looked amazing, but then by the time it was totally occupied, there was no further growth left for that place.
Correct.
Okay.
It has already satiated.
So you see which of these your areas are satiated and totally finished. Then you sell those assets first. Okay. Second,
Wonderful.
you also find out your cash flow requirement. And again, as per the rule, at least 20 to 25 times of that cash flow requirement, you liquidate from your assets and keep it into your liquid funds, which could be staged into multiple buckets so that you can withdraw and you can still grow your capital. Or third is, if you still want to keep real estate, you start keeping commercial real estate or warehousing real estate, which can give you confirmed cash flow every month, which escalates by, cash flow escalates by 15% every 3 years in terms of rent. Okay, and has a long lease with good tenants.
Okay.
If you feel nahi, meko real estate se paisa banana hai, so I think that is also one way you can look at it. So where you end up making 5 to 6% returns every year from the asset. Every 3 years, the rental will increase by 10 to 15%. And the asset values also increase as per the rental increase.
Right.
So this is the mathematics which you need to figure out.
Wonderful. That is very insightful, Sanjay. Thank you so much for such a nice answer. The next question is really an emotional one. It's from a Reddit user, individual repair 923. He says that he has shared the story of his father who retired at 60 years of age in 2007 with 84 lakh rupees. He doesn't have any pension and he decided to rent based on popular advice. That is, he himself started living in rented accommodation, basically. Now, what he's saying is that today his rent has exploded from 7,000 rupees to 42,000 rupees a month. And with 95 lakhs stuck in FDs and 35 lakhs in mutual funds, his expenses are crushing them. Was staying on rent a catastrophic mistake? And what should someone in that situation do today? That is the question.
How much time did it take him to reach from 7,000 to 42,000?
So in 2007, he started renting when he was 60 years of age. And today it is at 42,000.
2007.
So you can say approximately,
20 years.
approximately 19 years.
19 to 20 years. It has gone 6 times.
Yeah. Right.
So 6
Yes.
times if you take the rent from 7,000 to 42,000 in 20 years would be a CAGR of somewhere around 12 to 13% increase in the rent.
Correct. Correct.
Okay. Now, the problem was that he took rent, but at that time he didn't invest in equity. Because if that time they would have invested 84 lakhs in equity, that equity today would have been valued at more than, let's say, almost 6 to 7 crores. And that is that mistake which happened. So you now own an asset which is not even, which is giving you net zero returns, zero real returns. Okay.
Right.
And you have a rental which is going to increase every year. So that is a very big mismatch. That's a mistake, humongous mistake. It would have been better that this, if his ideology was completely dead, it would have been better for him to buy the house at that time.
So now that he has say 95 lakh in FDs and 35 lakh in mutual funds today because of his investments of that capital back in 2007, is there an approach or a solution that this person can now think through with the 1.3 crores which he has in order to manage his rental expenses and inflationary pressures on him?
So first is obviously I will suggest that because he is retired and if there is no urgency to stay in similar place, can he find out a place which is a little lower in rent? Let's say if it is at 42,000, can he move to somewhere which is 30,000? So that 12,000 first will be saved. Second is in this 1.3 crores, 50% of that should go to equity based allocation. Okay. Again, no, I'm not saying go to extreme small caps and others, but a good multi-cap or a flexi-cap fund will be a good choice for this kind of a person, because if he invests 65 lakhs and in 10 years it goes 4 times, then he reaches to a level of somewhere around 2.5 crores of corpus there.
Right.
And by that time, that 65 lakhs will go to zero in terms of servicing his rental and other things.
Hmm.
So then he will have 4 crore rupees, and then again he can start the cycle again. So this person has to invest 50% of his money into a good flexi cap or a multi cap fund, and ensure that and not ensure, but kind of hope that he makes almost 4 times returns in the next 10 to 12 years, so that this money is sufficient for him. And in this 12 years, take care with his 50 lakhs plus his FD interest.
All right. All right. So this can be followed. The next, we have two similar questions coming from NRIs. What they are saying is that they basically have a massive NRI contingent on our Fire India. I think you already know that from the kind of people that are demographics which are in the subs. And they're transitioning their journey back to India with their family. They wanted to know what is a realistic bottom up corpus to return without needing a high stress corporate job, and how do you find a genuinely competent fee only advisor who understands RNOR status and US India cross border tax treaties? Now, this is a question which we have to answer.
See, obviously there are very good FEMA consultants in India. You can search up them. And again, as I said, when you make a house, you talk to 3 contractors, 3 architects. So similarly, just find out at least, and it's very simple. You can just go online and check their websites and look up about their reviews on different platforms, and speak to 3 of them that I have this requirement and how much are you going to charge me for this, and what is the kind of thing I'm looking at. And plus, I think today with the advent of AI, a lot of things you can figure out yourself also. Obviously, when you shift back, there are a lot of things: what to sell first, what to sell second. Not promotional, but I have done a podcast on this with a very senior person on FEMA. You can also look at that on my YouTube channel. And it talks about
Sure, we'll
how
keep the
people
link in the description.
should when they come back from their stint abroad, what are the things they should look at? What should they sell first? Should they sell their house first? Should they sell their second house first? What all that things we have discussed in detail, so they can look at it and take a cue, and from there they can search for a good FEMA consultant, and then they can take this advice. I would not recommend anyone because obviously that's not my task. But what I would say is at least talk to 3 of them and talk to them with your condition, and you understand and see how to identify a right advisor. I think that is one question which people will have in this case. So first is obviously you do your Google search and other things, and if you have a reference, that's amazing. But I think whenever you talk to a consultant, is he giving you answer or is he asking you questions? A lot of people feel that if an advisor is giving answers, he's the right advisor. I believe the otherwise. If the advisor is asking you the right questions, he's a better advisor.
Okay.
So whenever you speak to an advisor, see the quality of his questions, not the quality of his answers and commitments. Because advisory is all about first understanding you. And if an advisor is having a lot of assumptions in his mind already about you, then I think he will not be able to help you properly, because then it is a off-the-shelf solution he will give you, which will not be tailored for you. And in finance, there is no off-the-shelf. Nothing is off-the-shelf. Everything is tailored, right? So you need to understand the tailored solution here, and you need to understand what this advisor is asking. Is he asking you right questions? If he's asking you right questions, he's the guy.
All right. So I think left faithlessness 921 and embarrassed content too. Both of them have got their answers, very rightfully so. The next question we have got is from a very interesting username called Save Puri Dahi Puri. I'm getting hungry now.
Yeah, me
Anyway,
too. It's almost
so
lunchtime.
yeah. Yeah, he's an aggressive portfolio teardown from him. He says that he's 30 years old, he's earning 2.5 lakhs a month, and he's saving
Wow.
70%. He's already
Very good.
sitting on a 1 crore equity portfolio. But get this,
Very good.
their equity is 90% of their net worth with a heavy 50-50 small cap and balanced split. And he wants to target 7 crore to FIRE by 40. Having already taken a 1.5-year career break, is this allocation a ticking time bomb or a calculated genius move? Your answers, please.
So see the allocation is not very bad. 90% equity, 10% arbitrage is good for a 10 to 12-year horizon. Second is he can definitely add a bit of mid cap here. 10% arbitrage will act as a kind of opportunity capital for this person when the markets go down. Okay. Now, if I take a very simple 14% CAGR, he is slated to reach 4 crores without doing anything much in the next 10 years. Okay, because he's already sitting on 1 crore. So 1 crore will double in 5 years and again double in 5 years. So in 10 to 11 years, he will be sitting on 4 crores of corpus. Additional 3
Correct.
crores, he needs to invest again heavily. Okay. And I think an investment of almost, let's say, 1.5 lakh rupee a month should be able to do his job for him, which he can do because he's saving 70% of his salary. So I think he's quite realistic, assuming he keeps on investing for the next 10 years.
All right. Wonderful. So I think you're doing great, Save Puri Dahi Puri, and I hope you got the answers that you were looking
And
for.
send some for us also.
Next, yeah, save some for us as well. Next, we have a question from Defiant Childhood 5456. He's to a very urgent real world crisis. He literally posted, I was laid off today. He is 38-year-old and in a tier 1 city with a non-working spouse. He doesn't have any kids, but he has 2 crores across financial assets and has an active loan of 90 lakhs for his home. What should someone's emergency triage look like in the first 30, 90, and 180 days after a sudden layoff when a massive EMI is staring at them in the face?
See, the person here has no income right now, and the wife also doesn't have an income. But the best part is they have good financial assets, almost 2 crores worth of financial assets. And I'm assuming, let's say, their expenses, barring the EMI, their expense comes to, let's say, 1 lakh odd per month. So in that case, they have enough to take out 1 lakh rupees per month from this. Now, the only thing for the first 90 days this person should do is learn a skill, because he's only 38. He's not 50. He's not 55, 45. He's 38. So he can eventually work for the next 12 years also. So I think first is this person should learn a skill and get himself job ready and get a job in the next 3 to 6 months. 3 to 6 months for him is very comfortable. He can easily take out and he should not stress. I think there are a lot of stress when you go lose a job. But when you look at this, such a beautiful financial savings which you have done, and you have bought 2 houses, you have a debt which is manageable. So I think in that case, first 90 days should go only in skilling and finding a new job. Don't find a job without a skill, without a new skill, because your old skill got you out. So that means very soon, if you join another company, there is a chance in another 6, 7 months you will be laid off just because you were working on the same skill. So upgrade yourself, go for a course. You can easily spend 1-2 lakh rupees on a course, or a 5 lakh rupees also on a course, which is worth it, which gives you a skill which can, get a better income for you and a longer sustainable income for you. I think that's what is required in this case.
So, once again, a wonderful answer, Sanjay ji. Next, we have a lady, 39 years of age, with the username worldly underscore trouble underscore 2264. She's basically struggling from burnout. She's 39, earns over 4 lakhs a month, and holds 1.8 crore in financial assets and a paid off 6 crore apartment. Equally earning spouse, no debt, and no kids. She wants to quit her corporate life and start a business with 10 lakh rupees investment. Her question is quitting right now the sensible move, and how should she ring fence her retirement corpus from entrepreneurial risk?
First of all, you're in a very, very, very smooth position, worldly trouble. I don't know why you kept your name worldly trouble, but take care. So, yeah, you're in a very, very safe situation. You have reasonably good, what do you say, liquid assets of almost 2 crores in mutual fund shares and PF. You have an apartment, which is very high value apartment. So that is also very good. And there is no debt. Just imagine you are sitting on pure equity, if be it in real estate or be it through cash. I think if it is burning you out, you can definitely leave it. But I think, I look at it in a form of a aeroplane. So no aeroplane in this world can land like this. Okay. Every aeroplane has to land like this. So pick up a plan for next 6 months. Okay. And in this 6 months, start your business in parallel and slowly and steadily, just glide down your corporate path and retire after 6 months, or let's say become financially independent after 6 months and start your business. So that is the thing to do. Don't leave it in a hurry, because when you leave it in a hurry, you leave it with a grudge. You don't leave it with a positive feeling. And second, you are not yet ready with your new business. So what will happen is, every time you will be anxious after you leave your job. Oh my God, I'm not ready. I don't know what to do. Give yourself 6 more months. In this 6 months, glide down the path from your corporate and take off your path from your business career. So by the time you actually leave your job, you have already figured out almost 70 to 80% of your business, and you can hit the ground running day one once you have the once you are out, and by the time in the 6 months you will earn another 24 lakh rupees, which will part of which will act as your fresh capital for starting the business. You will not have to touch your existing corpus for that. Second thing is, you have a spouse who's earning amazing, so great. I think when you have a spouse in such a way, it is great. You have a support with that person. You have no kids, so there is no immediate requirement also. And third is, to protect yourself from this, uh, always first make a private limited company. So private limited company is, as the name suggests, it is limited. So that means any liabilities will be sticking to the company only, company assets only. Your personal assets will never be touched on that. So in this case, I would recommend to go for a private limited company. Don't go for a LLP or a normal partnership or proprietary, especially don't go for these. You can start with a private limited company. It gives you better taxation. It gives you protection of your capital, and it gives legitimacy to anybody if they want to invest in your business tomorrow. So I think that would be my advice.
Wow, wonderfully put. So I think that answers her question with regards to burnout. I think you're in a pretty smooth place and you don't need to worry as much as you're thinking about. Just go through a slow glide path, as Sanjay just recommended. Next question, which we have, is from General Subject 3323. He says that he's a 32-year-old with 4 crore net worth and a paid off home, and he wants to target retirement at 35 years of age. But he admits that he's terrified of boredom, loss of identity, and being deemed unemployable if he changes his mind in the future. How do you handle this along with Indian relatives who demand to know what you do all day and ask for money?
Okay, buddy, general subject. First of all, you're in a very happy place at the age of 32. You are sitting on a 4 crore net worth. You have your own house and you have no kids. So I think that is kind of a dream for a lot of people. You're a role model for a lot of these Gen Zs who would see and say, okay, my God, I want to also become like that. So congratulations on that. Second, you are not answerable to anyone, buddy. There is nobody in this world you are answerable to. There is no society thing. Society always wants us to do the wrong things. They always wants us to be in a trap. They always wants us to be, answerable to them. They always want us to be. There is a word called set. आप set नहीं हो, आपके पास job नहीं है. Job मेरे पास भी नहीं है. My also relatives sometimes ask me, वो video बना के ठीक ठाक पैसा बनता है क्या? So we are not answerable to them because they are people who have not evolved themselves. They are not people who have seen how the transition happens. So they are not able to keep up with the speed of this transition. With the boredom part, I think before you take a retirement or become financially independent, kindly write down your top goals of your life. And see, one is goals which are your own consumption, which could be travel, masti, fun, all those things. But write down goals where you want to contribute, because let me tell you, long-term happiness only comes via contribution. The contribution could be free or paid, both. Like I am contributing in a way where I am able to guide people to become financially independent, guide people to help their money management, and in turn, obviously making my own money also. But you could say, no, I want to work for an NGO, I want to work for some social causes, so on and so forth, or I want to teach some kids which are, marginalized in their life. They don't have that possibility of learning from somebody like you. So I think find a purpose and write that purpose very, very, very clearly and chase that purpose after you become financially independent. Because I totally agree, totally appreciate. Even a person, I saw this case study where a person sold his company in US for $900 million. And still when he was asked, he said, I feel very empty and I don't have, I'm not very happy. So money after a point, money has no incremental value in getting you happiness. The happiness will only come when you have an objective, you have a purpose, and that purpose is to serve others. And even if you're making money out of that, that is not a problem at all. So find your purpose. You're very in a happy situation. Cut the noise, put your plugs on. Don't listen to your people. Just say yes to them. Be kind to them, and empathize with them that they're not being able to keep up with how the world moves now, and they still want you to be in that trap. It's not their mistake. It's just how they have been conditioned, but the world has changed and they're not updated to that. That's it.
Well, general subject, I think empathize and grow a thick skin is what Sanjay sir is trying to say. Right? Next we have AKC Triple I. That's a very fancy name. He says that real estate fraud is something that terrifies every investor. Aksi shared a distressing experience where they lost 1 lakh rupees token advance on a property deal in Metro despite having a signed agreement because the seller simply blocked them. How can home buyers legally and practically bulletproof themselves against property scams before handing over a single rupee? Is his question.
See, again, nobody in this country knows how to evaluate real estate well, and especially when it comes to legal and those kind of things. And that is why I request people to take a lawyer in between. If you're buying a property, it's a big decision. See, understand one thing: when you are buying a what do you say, even an apple, or say tomato, aloo, pyaz, whatever you want to buy, you look at the thing, you check whether it's fresh or not. You haggle with the guy who's selling you it, the thing, the vendor. And but when it comes to real estate, people go blind. They write a check of 1 lakh, 10 lakh, 15 lakh. 1 lakh is still manageable. I don't know what his situation is. But again, this leaves a lot of trauma. This leaves a financial trauma in your mind. And these scams do hit you. So my advice is, you please hire a proper lawyer, and the lawyer will have a checklist, and the person who is selling you has to adhere to the checklist. If that person is saying, no, I will not adhere to the checklist, that means that person has something which at the end of the day is to hide, and that is clearly showing the intent. Else, if the title is clear, is everything is clear, the person's intent is solid, he wants to sell the house, he wants to properly sell the house, they will give you all the information. So, and the lawyer will not cost you beyond 10,000 rupees. It's not a huge deal. If you're buying an apartment worth 1 crore rupees, paying an extra 10,000 will not make you poor. But if you're not spending that or investing that 10,000 rupees and something like this happens to you, it's a very, very big trauma. So my request to you, everyone, is that please, hire a lawyer before you take these decisions, and have a checklist. That checklist has to be completely fulfilled by the owner. Then you need to have a proper MOU or a contract, which is signed on 100 rupee stamp paper. And then you give that first check to that person. Take a receipt of that check from that person, and keep it with you. And then if something goes wrong, you have legal recourse available to you, and you can be protected. But if you are like he will never cheat me, and you give a blind trust, then it's your fault. Buyer beware.
Buyer beware it is. We have you stressed soul zero. He says that he's a 38-year-old dual income NRI couple in the Gulf earning high tax free salaries, but they have started late. So they have 60 lakhs invested, but it is heavily concentrated in physical gold and property. How should a Gulf NRI couple restructure their monthly cash flow to catch up, and what unique repatriation and insurance risks must they avoid?
Okay. So first things first, you are earning very well. That's a good news. And you're saving because there is zero taxation. I think, and you're sitting in Gulf, you have an opportunity to automatically invest using dollars, and you will not be facing the currency fluctuation, because the entire Gulf is pegged against the US dollar. So I think that should be utilized well, but the rules don't change at all. The rules still remains the same. What are your goals? You have to anticipate the goals. See, whenever you design a financial plan, you need to know the why, the when, the how much. Why is why I require the money: kids' education, kids' marriage, buying a house, buying a car, going on a vacation, right? So that's why. When I'm going to do it, after 10 years, after 5 years, after 3 years, after 7 years, and how much? How much will I require? And that how much is something which you need to calculate very well, because that's what is going to see that whether you achieve that goal or not. So how much is basically what is the value of that thing today, and you put an inflation figure to it, and you see where will it reach after 5 years, 7 years, whatever is your period. Then you start allocating basis that on your equity, debt, gold, silver, whatever assets you want to build. So this is how you need to prepare your entire financial plan. Second, when you talk about insurances, I think any person who's working in Gulf should have Indian insurances, should definitely have Indian insurance. It will not be very expensive. It is very, very reasonable. Please have that, because you will never permanently stay in Gulf. You will come back one day, because you never get the citizenship of that country. You may have a golden visa for 10 years. You will stay there for 10, 20, but still you will come back to the home country. And even if you don't come back under certain circumstances, it is always better to have that insurance with you, because if you come back and at that day you want to buy an insurance, you will never get an insurance. And if you leave the Gulf and your local insurance expires there, you will be insurance less. And that is some place you should not be ever in your life. You should always be covered with some of the other insurance in your life. So this is how you should plan stressed soul.
Okay, there it is. And I think the last question from the community we have is from Reddit user alone underscore policy underscore 2024. He has a classic young earner's dilemma. At 24 years of age, his salary just jumped 50,000 to 1.2 lakhs a month. Now he
Wow.
has a 45K monthly surplus. Yeah. And he has also a 15 lakh education loan hanging over him at a 10% interest rate. Now, Sanjay, his question is, does math say to prepay the 10% loan first or start aggressively compounding in equity mutual funds? That is his question.
See, the best part about investment and debt repayment is that it's not a husband or a wife. That means you can have only one, right? You can have both of them together. So whatever is the surplus, let's say 45,000 is the surplus, maybe 25,000 can go extra towards repaying the EMI, and 30,000, or sorry, rest remaining 20,000 can go towards compounding. So it's never an either or, it can be both also. It can be and. So I will do the repayment and I will do the investment. Both the things can be done together. And I always tell people that whenever you get an extra increment, okay, whenever you get an extra increment, put it into three parts. The first part is and the three parts should be 40, 40, 20. 40% should go towards your debt repayment, 40% should go towards your new investment, and 20% should go towards your fund. So if you have earning 45,000 rupees extra, let's say 9 to 10,000 rupees, splurge it. Enjoy your life, because obviously you will never be 24 again, right? So enjoy it completely. The remaining 35,000, you can put, let's say 20,000 as some investments and 15,000 as repayment. So broadly, a 40, 40, 20 construct should really help you for anything which you get extra. It could be an increment, it could be a bonus, it could be a windfall. Anything, you can work on a 40, 40, 20 formula and you will always be very happy about it.
All right, Sanjay sir. So now that we've come to the end of community questions, we have a small rapid fire segment. It's going to be a fast paced one. So we require your first instinct answer rather than a thoughtful one.
Okay.
Although, whatever you give, of course, we'll consider it with a pinch of salt. Firstly, first question, active mutual funds or passive Nifty index funds for the next 10 years?
Active mutual funds.
One financial product every Indian retail investor should completely ban from their portfolio.
Buying options.
Buying options, weapons of mass destruction. Is buying real estate for rental yield worth it in a tier 1 city today?
Commercial and warehousing is better, not residential.
Okay. The single biggest psychological mistake early retirees make in year 1 of their retirement.
They put entire capital into equity. They don't stage their capital.
Wonderful. Once again, thank you so much, Sanjay sir, for such a lovely and patient interaction. We are so delighted that you gave us so much of your time and patiently answered all our questions. It has been a masterclass in clarity, sanity, and actionable wealth creation. You didn't just give generic advice, you actually probed them down into exact formulas, psychological traps, and real life blueprints for our community members. We cannot thank you enough for dedicating your time to this initiative, Sanjay ji, and we couldn't have asked for a better first guest. Your
Thank you
thoughts?
so much, Snaky, and thank you so much for the community for asking such brilliant questions. My request to you is that in finance, not making mistakes will take you 10 to 20 years ahead of people who are making those mistakes. In finance, if you make a mistake, you just lose that 10 to 20 years in one go. So my request is, don't make mistakes. And if ever you have an urge to do something new, do it with a very small capital out of your entire portfolio. Check it, test it. As Warren Buffett says, that don't test the depth of water with both your feet. Always test it with 1 feet. And then you make the plunge and decide whether you want to do it or not. Don't go for exotic products. Go for basic products. Your dal chawal products, which are mutual funds, will actually create more wealth for you. And understand the suitability of the asset to the requirement of your goal. If it matches, you will never have any stress and you will be able to sit on this investment for a long time and you will be able to make money. Thank you so much with this. If there are further more questions, we'll definitely take for the community. I'm always there for the community. This is my service and this is for what I became financially independent. So it's always an honor, privilege to be serving the community to the best of my knowledge and best of my understanding. Thank you so much.
Thank you so much, Sanjay sir. Once again, we'll definitely have a part 2 with you because I'm sure there are going to be a lot of follow-up questions to the answers that you've already given. And folks, if you found value in this breakdown, please smash that like button, subscribe to the channel, and share this with anyone working towards financial independence, because your support helps us to bring guests like Sanjay sir and people from the other diverse assets spaces of financial freedom and talk to us about your queries, etc. as well. We'd also request Sanjay Sanjay sir to help us connect with a few more of such people. And we look forward to having second part from you, sir, very soon.
Thank you so much, Neki. Thank you so much, and thank you so much to the community.
Thank you so much, Sanjay sir.